is Phil Rockcliffe with Rebel Financial. Thanks for joining us today for our live broadcast. Sorry we're a little bit behind, but as always, we are trying to grow into our new building, our new studio. So appreciate you bearing with us today. We've got a really good kind of financial planning subject, and we're trying to put it out there. We're changing around the live broadcast a little bit, and just to kind of telegraph it out there, I think once we get everything up to where you can see the next couple months planned out, you'll get the gist. But generally what we're going to do is 3 live broadcasts per month. One will have continuing our special guests from around the community, whether it's business or planning or investment or charitable organized. That is still going to be a core of what we do. 1/3, the next one is going to be from our book reviews like we did last week and we're doing next week. And then the last one will be a subject like this, where we do a financial planning or investment subject, where we can kind of give some of our knowledge out there, build our library up for you guys to be able to use and help you be more productive. So today we're doing some easy moves that you can make, moves that you can make before the end of the year to help you tax-wise or planning-wise. So first of all, the easy ones. So I'll let you take that away, Tony.
Yeah, the low-hanging fruit. So at the end of the year, people are looking for things that they can do to lower their taxes. And what they're not always thinking about is making sure that they've maxed out their 401k, 403b, retirement plan at work, basically, because it could be a simpler stuff too. I realize, stuff you can't contribute. But and then in addition to that, sometimes people neglect IRAs. So depending on your income limits, you're going to be able to put money into possibly a traditional IRA, but if not that, possibly even maybe a Roth IRA. So, and you just want to kind of look at those and see, which ones are going to be better for you. So that could be a lot of money right there, and a lot of people miss those opportunities.
Yeah, so check. Look at your paycheck and see where it says on there how much you put into the 401k. If you're under 50, you're allowed to go up to 19,000. If you're over, you can go up to 25. If you're not there or you're well below it, I know a lot of people set theirs maybe a couple years ago and the IRS increased the limits and they just haven't turned it up. So there may be some extra that you can get in there for the last couple paychecks or maybe a bonus or what so, to where you can get extra tax deduction. Or if you don't need the tax deduction because you get a lot of credits or kids like we do, then do it Roth, so get the tax free for later, whether it's tax now or tax later. Those are good things that the government's giving you. Don't lose them if you've got the cash flow or savings to be able to do it. And I think we bring this up to our clients a lot, but I think a lot of people that are kind of doing it on their own, they don't think about this. But if you've got after-tax savings or an inheritance or something, and you're not maxing out your 401k or 403b or IRAs or Roth IRAs if you're eligible, and especially the next thing we're going to hit into, the HSAs, that's wrong. Some people might just say, I can't afford to take that much out of my paycheck. Take it out of your paycheck and get it in there and deposit some of that money from your after-tax savings or investment account into your checking account and get the tax preferences. It's almost like being able to contribute more than just the $6,000 or $7,000 into an IRA or Roth IRA. There's a huge tip right there. So HSAs, let's hit into that, Tony.
Yeah, so HSAs are, they're not that old relative to, retirement accounts, so to speak. This is specifically for medical accounts, right? This is often neglected. People, they're not using this well enough. And you get a tax break going in, it grows tax deferred, and it comes out tax deferred if you are using that for medical expenses. And if you wait till you're 65, it would work the same way, but you could actually use it for other expenses. The difference being is you won't be penalized like you would be if you used under 65 for non-medical. You'll just be taxed on again. It will look more like a traditional IRA than anything else. But it's an additional $7,000 a year for families, and so you need to be taking advantage of that.
For sure.
So that's something. It's just underused.
A lot of people would argue that you should be maxing out your HSA before you max out your 401k. If you can't do both, max out the HSA first because you get triple tax. You get you get a pre-tax deduction. You get it to grow tax deferred, and you get to take it out tax free. Whereas with the 401k, you get one or the other, pre-tax or Roth. This one's both, so make sure you're doing it.
Yeah.
Right?
And one last point, and this is not, this might be overkill for some people, but if you've maxed out all your retirement accounts and you have small medical bills, you might want to look at just leaving your HSA intact and then just using cash to pay for those things. But that's more getting further down the line in planning. But Just a thought.
And just in terms of HSAs, like if you have an advisor or what's so, it's really come around. We help a lot of our clients, through HSA Bank and TD Ameritrade to manage those once they start to actually build some money up. You can actually have investments in those, and we can grow it at 5 to 10% per year, depending on, how aggressive you are and what your goals are for how we're going to use that money. So, who knows? You do that early enough, and we compound it for 20 or 30 years, then you may get double to quadruple the amount of money in there to what your principal base is. And that's great. That's like the government paying a lot of your bills right there, your health bills later on. So, all right, let's go to the next subject, which is going to be charitable deductions. So obviously this one's thrown out a lot as an easy one to lower taxes or do at the end of the year. So what are our thoughts on that?
So with the tax changes that happen, charitable deductions might not be as useful to you because the reality is you might not be itemizing. So it might not be, from a tax point of view, a benefit to you. But there's a way to engineer your taxes so that you can benefit from that. And that is kind of stacking your charitable contributions. So you may not be able to itemize every year, but you can build what your own personal donor advised fund, put money in there that you're going to distribute for the next 5 or 10 years. And so one year you'll get that lump sum deduction, and then it'll put you over that mark, so you'll have a high deduction that year compared to the standard, and then over the coming years you can just use this fund that you've already contributed to then pay to the charities that you want to pay the money to.
And I mean, this is a thing that we recommend a lot. We have few people take us up on it because I think it's a newer concept, but we'll throw it out there for you too. I think as people get more used to it, they'll do it. But a donor advised fund is a nonprofit that all it does is take your contributions and make a portal to where it gives money to other nonprofits. And so what that allows us to do is put the money in there. You can still invest it and grow it, and then you can give it out little by little over time. So then that way, if you are stacking every year, every other year, or every third year, you're not starving those charities in the middle just for tax purposes. We could still give them stuff every year. We just took the deduction when we put it into that donor advised fund. It's kind of like the middle class foundation, because it costs a lot to start some of those organizations and to do all the taxes and et cetera. So if we're not going to put over $1 million in there, a lot of times it doesn't make sense. We can do a donor advised fund. It'll help you tax wise. And then even kind of getting into our next subject with Roth conversions, you can do some really creative planning, especially if you have an advisor like us. We can model all this stuff out and show you. But say you're charitably inclined and you want to give, $100,000 over the next 15 years or so, little by little, to different charities. We can make a one-time big contribution into this donor advised fund, get a huge deduction, which may be way more than what you need, but we can do a Roth conversion to where over that 15-year period or what, so that money may double, and we have to keep all the growth 100% tax-free. So the government may have, in effect, made a third of that contribution for you, right? Or you could have contributed $130,000 versus $100,000, and you gave the charity more, right? So it's almost like the government's matching you on your charitable giving beyond just the tax deduction. So that's like awesome. So let's talk a little bit more about Roth conversions. I'll let you take that, Tony, without even the charitable.
So, what we're looking at when we're determining the contributions we're making to a retirement plan is, when is the best time to pay taxes, right? You want to pay taxes when you're in the lowest tax bracket. So in some cases, when your income is off for whatever reason and you've got traditional contributions into an IRA or a 401k, this might be the right time for you to make the contribution and pull the money out, switch it to a Roth, and then pay the taxes. And once that money's in the Roth, you're not going to pay taxes on it again. But it's a matter of
tax arbitrage.
It's a tax arbitrage.
Yeah.
So you're just really looking to pay taxes at the best opportune time. And overall, I mean, if you're in your work life, you might be at a very high salary, so it might not be the time to do it. But we also are in a very low tax rates right now.
Environments,
are low. Mm-hmm. And although we say this every year, it's not going to go any lower.
Probably. Who
Once
knows?
again, probably, who knows, they might, but, so that's just another reason why it might make sense to do that. So just something to take a look at, and all these things are why having financial
you can
planners
see
there's a lot that can be done.
it's a big red flag or like a variable that there's two of them. If you have one of these two things, that Roth conversions will probably work well for you right now. If you have both of them, it's kind of a double whammy. Number one is that you retire pre 70 and a half. So a lot of times before you hit required minimum distributions, if you have a decent amount of free tax, which most retirees do have, that may be a good opportunity for Roth conversions, just because your tax is going to be lower than when you step up, when you have to start taking out more that the government requires you. The second thing is if you do have after-tax savings or after-tax investments, because a lot of times instead of withdrawing from the pre-tax stuff to supplement your Social Security or pension, you could withdraw solely from that after-tax thing, which for a lot of our clients, they may have a few years where if they did that, they would almost pay zero tax. And that sounds spectacular, but it's a really inefficient because we don't want to go from paying 0 to 30. We would rather be paying 10 or 12 and then only jump up to 22 when it goes up. And that tax arbitrage could be hundreds of thousands of dollars when we look at it 20 or 30 years down the road with the same amount of standard of living. Okay, so we're going to move on so we don't make this last too long. Kicking into health insurance and open enrollment. That's what everybody's working on right now. Let you do that again.
So, you want to look, we have a lot of flexibility these days in healthcare. It may not, healthcare insurance specifically, it may not be the smoothest industry to have to deal with, but you want to look and see within work and with outside of work, what opportunities you might have for yourself. One of the things that we talked about before is how many people really should have an HSA and they don't within the program that they're with. So, and the other thing is, long-term planning is if you do retire early, you might be on the Affordable Care Act under, and so keeping your income low and kind of working around that will make your health insurance.
Well, there's a lot more people now that do their own health insurance. It's not just through the employer. I mean, if you're lucky enough to work for a really big employer that still subsidizes it and it's affordable, less than a couple $100 a month in your premiums. You may not know this, but you're really lucky. For the vast majority of people working for small businesses or maybe self-employed or maybe pushing off of their parents' insurance after college, you need to shop, and so that could be looking at the marketplace, so what is available through the ACA, and looking at the private marketplace. You need to shop those and understand like what your needs are versus what's available, and even this year, even more, because whether people agree with it or not, we just deal with the reality of helping you guys, our clients as well, just do what's best for you. And they're tearing apart a lot of the things of the Affordable Care Act or Obamacare. And so there's going to be some new private policies available on the market, which may be less expensive. And if you're in a situation that benefits you, don't just think you shopped the last couple of years and you're just going to renew because you're busy. I mean, you could be talking about throwing away $1,000 to $4,000 a year by not doing an hour's worth of due diligence. Right. If you don't, I mean, worst case scenario, just call a health insurance, broker and have them look it up for you. Tell them your situation, talk to them for like 10 or 15 minutes. They can do all the work for you because if they place a policy, they're going to get paid. And a lot of times it doesn't, most of the time, it doesn't cost any more. I mean, I know, Sean Tonetti has helped us and even some of our clients and employees find policies. So, find someone local to you. We'll put a couple, kind of links for you to follow if you're not sure who to ask on that. So, moving beyond the insurance, like Tony said, make sure if you don't have lucky enough to have like a Cadillac plan where your deductible is only like $1,000, your deductible only has to be $2,700 before you can have an HSA. But if that health insurance company doesn't make the policy right, it may not be HSA eligible. You should almost always have a policy that's HSA eligible if the deductible is higher than that. I mean, why not? To put that money in there, get the juiced up 401k for your health expenses for hopefully the rest of your life. Make sure you do the due diligence on that. If somebody gives you something back and it's a good deal, but it's $5,000 deductible, and it's not, ask them, is it HSA compatible? Sometimes they'll be like, no, and you're like, why would it not be?
Yeah.
Well, there's an equivalent one, but it's $3 more per month. Like, so what? Do the HSA eligible one.
Right. Well, and when you're working with that insurance
Yeah.
person, tell them, I'm looking for a high deductible with an HSA. Start the process from there. If they have some other ideas, listen to them, but the HSA is just such a valuable component of a high deductible plan. It should be with everyone.
So heading into the next part, Tony is our in-house accountant. So, some of the changes with the tax law for health expenses.
Yeah, so prior to this year, like in 2018 and before that, you were able to write off healthcare expenses once they exceeded 7.5% of your adjusted gross income. That is now changing to 10%. So it's even harder to get to that number. For most people, they're not going to get there. And it's when you are probably having a really bad year from a health point of view that you're going to get to that number. However, so if you've got a family and things are happening, you may just have some years where things are just happening and it's bad luck. But if you really have elective surgeries or you can plan a little bit, just take into consideration those years when you do have a lot of health issues, and you may have somebody in the family or yourself that has something electable. Yeah. Then put it in that same year.
Stack it up again.
Stack it up, right? And by the way, we should be stacking all these stackable deductions. So if you don't have anything this year, you don't know what's going to come next year. So wait till the beginning of the year and then use it that year. And if something else comes the rest of the year, well, now you've got a better chance of getting the deductible because you waited to have that electable surgery or process, whatever it is. So just something to think about because there's a lot of opportunities with medical. It's just hard to get to that threshold. Hopefully you never need it or get there. Yeah. But if you do, you might as well.
That goes for anything. I mean, like stacking like that, you should be smart about it. I mean, like just for deductibles and max out of pockets. If you know you're going to need to do something, or you need to kind of do something now, but you could hold off and somebody's going to have surgery next year, then bam, do both things next year, and you may get one of them for free rather than paying the deductible twice, the end of this year and next year, right? So, I think a lot of people are pretty savvy on that side of it, but it can be a double boon to you to get the tax and the deductible as well.
So these days, if you had a baby, try to get all those surgeries in the same year because I know how expensive it is these days.
And then, I mean, we're getting ready to wrap up, but some of the easy things, but you just had a phone call like this a couple of days ago. I mean, there's easy things like somebody needed a distribution to help pay for something that's going on in their life, and they asked us to do it right now. We're like, well, can you wait a month? And they're like, why? Well, because if we do it at the beginning of January, you got a whole another year until you got to pay the tax on that, right? Unless there's some other reason to accelerate it now for something else going on. But there are lots of things that you can delay distributions or you can accelerate them if something was going on this year to where your AGI was going to be a lot better and you're only going to pay 10% tax this year instead of 25% next year. So take it out a month early, right? So, just thinking about these things, especially when you get pushing into the holidays, especially because it's not that much time between one year and the next. The last few things we'll put out there, and this is where you really should, touch base with your accountant or financial advisor or planner, but a lot of times you can harvest losses from your after-tax investments. You can defer compensation, or if you're going to get a bonus or performance compensation or what, so there are ways, maybe to get that into your 401k. Or now I know a lot of our clients that do work for bigger companies or what, so have open enrollment for deferred compensation. Okay, and so a lot of people they forget it, or they know that it's kind of a benefit, but why do they do it? In addition to anything else. But a lot of times you can make bonuses go in there, or what, so, and not your regular pay. So if next year ends up being a gangbusters year for your company, it's just not going to slaughter you tax wise, and you have additional savings for retirement or after you separate. And then lastly, if you have a business, make sure that it's structured right. Make sure you're doing the right things, because with the new tax law changes, we got QBI. So just real quick, tell them about QBI.
Yeah, so qualified business income. When, again, beginning of 2018, we had new tax law changes. Corporations, big one, got the lower rates. So they gave small businesses this break, and basically it's taking 20% of that income and deducting it. It's really pretty, it's great and has a lot of qualifiers with it though on how you position it. So you want to make sure you're talking to your planner and your accountant and getting it done right, because you could be, as an example, you may be, if you make a pre-tax contribution, then you're lowering your income by whatever amount that is, and every dollar you're lowering that by, you're losing possibly that 20% deduction. And so there's just a lot of moving parts to it. So just make sure you're having these conversations, especially with your accountant, and so that they are looking and trying to figure out the best way for you to position not just your retirement contributions, but a lot of other expenses.
Yeah, because you should test it out. Make sure you're structured right. Like in that circumstance, you could still do Roth contributions instead of pre-tax, and you might get as much deduction because you don't lose the QBI.
They never pay taxes,
right? So again, these are some things that you may need some help with when you get there. These are some end of the year moves you can make. Really, you can make them anytime, but we're trying to bring them up, so maybe we can help you before the end of this year. If you have questions, let us know. If you need an advisor, by all means, reach out to us. We always like to plug our main association, NAPA, National Association of Personal Financial Advisors. That all of the advisors are fiduciary fee only. So even if the government doesn't make people be fiduciaries and do what's right for you, there's a lot of us that are a part of organizations that dedicate to do that voluntarily. So NAPA, you can Google that, and there's a Find an Advisor app on there. Of course, you can reach out to us anytime. So thanks so much for tuning in. Join us next week. We're going to do our book review for Everybody Lies. Hopefully you read it too. You can follow along, make some comments, and engage the conversation.
It's a great read. It's a fun read. So try to pick the book up before then. But otherwise, we'll be talking about it as well.
Yep. So have a good weekend. Hopefully you're not freezing. We'll see you next week.